Hello ladies and gentlemen, and welcome back. In today's video, we discuss everything to do with the stock, commodity, and crypto markets right now, and more importantly, focus in on this very important level. As we've mentioned now for the last 2 to 3 videos, we've been bullish on the market from this point. In the previous sessions, we've seen it break out, and that leads to potentially a further upside before a really big decision point is made. Why, you might ask? Gaps. We have left inefficiencies in this market, and of course, we're just about to see the Jackson Hole Symposium speech by Jerome Powell. So will morning tea with Jerome bring us some downside, or are we going to rally first and then potentially fall in the future? Stay tuned as we take a look ahead at these markets. Welcome back everybody to the Daily Show, where we talk about markets around the world. But I want to start just quickly here about inflation and of course what's happened in the past. Now, a lot of people don't know this, but the only times that we've ever beaten inflation as a society since the 70s have been to push the funds rate above the CPI number. That's always been the way we've beaten inflation once inflation has gone above 5.5%. Now, of course, sitting in 2022, we know that inflation is sitting at about 8.5% at the time of this recording. So does that mean that we have to go above 8.5%? Well, the problem is debt. Remember, our society is based on debt. And to clarify it, I believe that if the Federal Reserve pushed anywhere higher than maybe 5.5%, at least in my opinion, they would not only cripple the economy and demand, but they would cause a Great Recession. We're not just talking about a normal recession, we're talking a Great Depression recession. So we've got to consider debt into the equation. Even though this has been a stat, we've never beaten inflation without pushing funds rates above after 5.5%. I just want to clarify that I don't think it's possible in this situation without causing such a cataclysmic event that it would go bad. Instead, what would be more likely is that we have sticky inflation and the Fed controls the rate at a much higher level, definitely hurting, of course, the US economy for a longer period into 2023 and possibly 2024. This seems like the most likely scenario, and I just want to quickly clarify that here today to make sure that people are aware that while I don't believe actually they'll get above 4% on the interest rate and they'll be more likely to stick within this 3 to 4% kind of range, this is something that a lot of people had an argument in the comments section before, and you could totally disagree with me, but the way I see it is there's a straw that breaks the camel's back, and at that point, if we go past 5.5%, it'll just cause an absolutely cataclysmic event across the world. It's all got to do with housing debt. If you don't believe me, go look up housing debt to, of course, the general debt society that we live in. It's pretty bad. So what's going to happen now in the Jerome Powell situation, which is, of course, the Friday speech, breakfast at Jerome's? I won't go over this anymore because I talked about it in the previous video, but the expected ceiling is, of course, around 4% from most economists. In general, most people think 50 to 75 basis points from Powell, and at this speech, the Fed will just continue to say they're going to beat inflation and really just make sure that the market is aware that they are data driven at this stage, but also that, of course, they want to beat inflation. There's not necessarily going to be this big pivot angle. Who knows? Of course, predicting the future is going to be difficult there. We can only look at the charts, and that's what we'll be doing today. If we're thinking about seasonality and, of course, general times that have happened in the past, the big thing that has happened during midterm election years is the midterm elections themselves, and markets have generally driven down through the August into September, October period. You can see the comparison to normal years and midterm election years. This is now starting to become the narrative that's going out there to everybody in the audience. And of course, we all are aware of this, but it does open up a serious opportunity for traders should we see the dipping scenario later on. Of course, these are some of the closest correlation cases that we've got so far right now. Obviously, there's a bull and a bear case, and I've made the point, the biggest important thing is that in all of these correlating cases, we've generally seen markets pulling back to the lows, if not making new lows. So whether you're a bear or a bull, it's not really the time to feel too much FOMO right now. We just need to understand the ways that markets generally get to these lows and then focus on, if that's going to happen, how are we going to trade it and how are we going to profit from those, of course, actions. Let's discuss here what happened in the last 24 hours. Guys, this was pretty interesting because it actually followed exactly the line that we discussed in the previous video. A break of the 41.62 on the SP500. a pullback to close part of that gap, getting very close to the 41.40, which is exactly where the gap was. I think it went about 3 or 4 points from that. And then a huge rally into the end of the session, giving us a Nasdaq about 1.75% and of course an SP 500 about 1.41. Pretty exciting stuff. I certainly liked what I saw on the charts. Semiconductors, of course, was the best performer out of this. Whenever we see a really big risk on kind of session, generally semiconductors do very well. And more of the same. We got this inkling really from the previous session. PBW and TAN, the solar, those ones that tend to go early, also did well in this session. So again, another strong day for risk on in the markets, and the risk off sectors weren't really doing that well. Could there be more in this market? It bodes towards a little bit more of a bullish move first. The VIX is moving back down as well. Of course, this means fears coming out of the market ahead of the Jackson Hole Symposium. Anything can happen and it can flick the switch, but realistically, it's coming back down here, 21.79. I still expect a kangaroo style, market here with a pretty big spike up in fear moving forward. But we do also need to remember in the US, the summer holidays are almost over. What does that mean? It means the big traders, they're coming back. They need to pay for those expensive yacht holidays. How are they going to do it? It's going to be an interesting volatility time because in general, when people come back and these big hedge fund managers come back, they start to, let's say, sense the opportunity. And that's why you often do get, after earnings season, that September real fade into October. Could it happen again? We'll be looking at that in our weekend video. So make sure you stay tuned because I think you guys will really enjoy that one quite a lot. And all of us need to understand these are the times that really make or break a lot of traders in the system. The US 2-year is at the resistance ahead of the Jackson Hole Symposium, waiting for the Fed. Of course, we can't really predict what it's going to do next. It's at a resistance for a reason. It's waiting for the news. It'll make the decision from that point. And if you have the patience, then you can react to that with the right strategies at the right times. The US dollar is pretty similar. Hit the equal high here, 109.264. We talked about the resistance there. And of course, we've discussed the idea of it weakening through the last couple of sessions. The previous video we did and the day before where we talked about the recovery from this in the short certainly have come through, but it's been kind of lackluster, I'll say that. It hasn't really continued down heavily because it doesn't have the catalyst to do so. Of course, at this point, we don't really know what's going to happen next, so we have to just look at the charts and have the patience to recognize the opportunities. There's a real chance that we actually spike this high and then come back down and retest this low. At that point, taking shorts would be a pretty good opportunity. At this point here, I'd still be bearish on the US dollar from the small time frames, but remember, this could all be syncing up to creating a flag with a breakout pattern. So you've got to be very, very careful here. And in some ways, the best possibility sometimes is closing into these events and then recognizing and moving with the market after that point. The US dollar again is the same thing. I mean, if you look here, of course, we got that pull down off this level. It picked back up to the 61.8 into the 78.6 fib. We saw a short from that zone. So far, it's been okay. It's still in profit, but is it strong enough? Well, you would say, again, it's pretty much at a little bit of a technical level. You can see here the little downtrend. It hasn't made a new low yet. It's not really showing us too much at this stage. If you were looking at it on the surface, you'd say, again, it's short from a technical perspective, but we don't have Jerome Powell's speech. We don't exactly know what the Fed's going to do, and both could certainly play out. And that's the problem. You really want to stack the odds in your favor as much as possible. Gold sold off in the last 24 hours. Of course, we still have, this is kind of the major zone we're looking at in the future between that 1710 to 1720 zone. That's going to be a big one for gold in the future, should it get there. And from the resistance sell side, we're looking at around that 1772. It's going to be a really important zone. I think a lot of us are looking at that now. I've seen your comments down below. 1772 to 1776, this area here, if gold gets up here, I think there's a chance of reversals off that level. And of course, you need to activate using multiple different concepts. Don't just have one reason why you like a level, have many reasons. It's about stacking the odds in your favor as a technical analyst or anyone that's really looking at these markets. US oil and UK oil both dropped a little bit on the last session. Of course, UK oil here has been the lead. We got really bullish on oil after seeing this candle, rightfully so. At this point, it's on the support, really looking to possibly ramp up into the speech. Now, if yields go higher, that is the US 2-year and US 10Y goes higher, expect explosive action from oil. Basically, if oil loves yield, if yield goes up, oil loves yield. So if we do see yields break out from the top, and of course, if we load the US 10-year here, you can see where it is. Let's say we get a new high here. Oil is a good friend of that yield. Let's just say that. Move over to Tesla. Of course, the split happens. It was a nothing burger. The whole thing literally just came up to the same level and then sold off and pretty much didn't do anything for the session. If you've been watching our analysis for a little while and talking in the community, we obviously have been talking about this particular zone here, this 303, 304 zone being a pretty heavy resistance for Tesla at the moment. It's kind of the most touched area. And the market kind of got in, gapped, and then just sold off. It really didn't find the strength through the session. No one was really trading Tesla. And I think a lot of that was just because the market makers were taking advantage of the options skews underneath. Everybody was getting on it. Everyone was like, oh, we've got to get in on this trade here. And it just so happened that wasn't the best possibility or option at that stage. What happened with Apple, though, was more interesting because Apple, of course, came out, did a pretty good session, 1.49%, much worse than semiconductors. But we have the top end. Now, we know there's a gap fill in here. There's also a gap that was left behind. Some people would say, oh, that basically filled. So we'll focus on the big one here. And the big one takes us back to around that 171.45. Now, if we get a little bit higher, you can see here we're on the top end of this volume profile. That sits around 172. So what happens if the market gets back to 172? Well, let's just think about it logically. At this point, there's a reason that potentially we could sell. Is that going to correlate with the stock market being at key points? What if the market got back up to here? Would it trap a lot of people into a bullish case scenario with a bearish case later on? There's going to be trying to be sellers here, but selling Apple is not easy, guys. I mean, think about it logically. If you're going to sell the market, would you really want to sell one of the best stocks in the market? Or would you rather sell like a bit of a crappy stock or a more high beta kind of stock? Well, this is the thing that you've got to really think about here. And again, Apple, it looks like it wants to fill the gap. So at this stage, you'd be going with it looks bullish on the close into the next session. Hopefully it is. Move over to DAX, similar thing. You'll notice here, market's moving up. Again, a bit more upside is certainly a potential. Upwards of that 13,650 is certainly very, very possible here from the charts. We'll get rid of this now. We don't really need it. But this area here is going to be kind of a target, I think, for a lot of people in the German market. And it came right off the base that we've been discussing the last couple of sessions. Good 2 days of trading, no doubt a great level. And hopefully a few of you have been having a look at it and coming to a similar conclusion with your own analysis. What about the Russell 2000? Well, this probably was the standout trade, I think, in the last couple of sessions. If you really think about it again, a lot of people will see this as kind of like a doubling bottom or tripling bottom. It tested this level perfectly and just bounced off it, actually went slightly underneath, just like the SP 500, took the liquidity and then just bulled up hard. Targets for this, a lot of people have got that kind of 1980 to 1990 zone. I don't blame them at all. There's gaps left everywhere in IWM, the Russell 2000. Of course, if you want to see the gaps, type in the code and then you can see here where the gaps are. So the gap closure for IWM, the first one, would be 198 in this case. And we closed at 195 at the time of this recording. So did it come off a good zone? Yes. Is it looking bullish into the Jackson Hole? At this point, yes. Could we see a spike where it comes up first and then moves down? Absolutely. And that's something I want to discuss with you guys right now, because I think all of us are looking at this from, well, even if it's going up, I still might be bearish, or I still might be, maybe I'm bullish and I think it's making a new high. This is a very pivotal time in this market. A very hard decision has to be made soon. So let's move over here to the Nasdaq. Similar thing. Beautiful base. I'm sure a lot of you were looking at this bullish yesterday. Fair enough. Great trade. Well done. Great base. 13,000. Big psychological zone. Where is the most likely scenario for it now? Well, it's probably going to be around that 13.3 to 13.4. Why? Because that's where we have the previous structural zones. So again, just think about it logically. If the market wants to pull up, which it probably should, ahead of potentially even moving further down, that's the kind of scenario that we're looking at here in markets, and a good one to check out in your charts. S&P 500, the most important chart out there. Similar resistances or structure over here, support, great base. Of course, we've talked about it here in the community a few times. It's looking really good, came off a good level yesterday. It's left a small gap behind there, which we've got most of the gaps kind of targeted out. And you can see here it closed around that 41.99 zone. So what's next for the S&P? Will it get back up to the levels? Well, we've theorized the idea of it moving towards filling some of these gaps. And we've got two of those gaps here on the chart at the time of recording. So we know that 42.28 was left behind. We also know that 42.82 was left behind. If both of these levels were to fill, would that convince many people to go into a new bull market? Most likely. Outside of this community, most people would be convinced it's a new bull market, and they could be correct. Of course, this is trading, nothing is absolute. But if we think about Fibonacci pullbacks, we think about where the market would go to an extreme, somewhere in here would make a lot of logical sense. We've got previous supports across the board, previous resistances. In this area is effectively a boxed zone of interest. So if the market is to continue going bullish, we've got to be open to the idea, and of course you always have to be open and flexible as a trader, to this zone. I mean, shouldn't we? We should always be open and flexible to a zone like this. What an interesting area for us to check out. So this is a big one in the future. If we were to look at this from the perspective of where's this market going to stop? Of course, anything could stop here, but it seems likely that it may try to run into this zone. At this point, will the bears take control of this market? This is where you make the big decisions, and will markets then push towards things like the 3920, the 3900 down here, the 4000, 4070s. All of these areas become super interesting down here. So remember, we've got a lot of gaps to fill. The market's currently ramping. At the time of this recording, it's basically at 4200, which is a psychological point that was barely respected last time. So what makes us think that this is going to be heavily respected this time? It's probably not. And of course, we're ahead of the news. So it's going to be a very, very important one. What about the options? Well, the max pain sits at 415, which is actually slightly under where the market is right now. The other thing is, if we look at the calls, we've got a lot of calls at 430. So I don't think they're going to be making money on Friday. Do you guys? I don't think so. 420, 31,000, 415, 32,000, and 410, 36,000. So 415 to 410 will be most likely the base come Friday. So we've got a bit of a base and we've got a peak. Now that gives us a pretty wide range. So for the markets during the session, we've got to consider, well, what if we got a huge amount of people buying in calls? Could we push that max pain up? The max pain will move through the Friday session. These are not that important in terms of the non-third week expirations, but it's still important to know where our supports are and where our resistances are by the options for the end of the week. At this point, it looks like a 420 would be a good level to close on, or possibly even a 425, depending on how the market moves for the max pain. Bitcoin's kind of similar. It's absolutely just crappy. I mean, I look at this chart and I think, wow, it's so slow. But it has been doing a little bit better. I would have expected this to actually break out to the bull side. It didn't do so. It actually slowed and didn't even get a new high, which is kind of weird. If you go over to Ethereum, it's been a lot more in line with the stock market. Check out this. I mean, Ethereum is just so much better at the moment from the opportunities that's been rising and going through. Created a double bottom, broke that double bottom towards the upside. At this point is kind of like on a trend line towards up. So you can see here, the smaller time frames, you've got a trend line. And there's a real chance that if the stock market ramps, that Ethereum could get back into these 1800 to 1900 zones where all of this kind of problem first started. Again, at that point, the bulls and the bears will have the decision to be made. So a very interesting point, again, checking out the markets. If you haven't already, come and follow us over at FX Evolution on Twitter, join our Discord community. And of course, if you want to join our private community, links in the description down below. Free 7-day trial if you want to find out more about how we do it and what we do. And as we know, Jackson Hole Symposium and Core PCE Price Index. Now, the Fed technically uses this number to figure out the, let's call it, inflation in the future. They call it their lead number. So little wonder we've got, of course, breakfast with Powell just after that. How will it work out? We don't really know. Of course, the market is expecting here a 0.2% read. At this point, it looks like the market wants to go bullish before bearish. At least that's what we're seeing in the charts. And of course, we'll come back at you with a great video on the weekend where I think we'll have a little bit more clarity to this situation. And hopefully we're at a critical zone so that we can make some decisions in the next week. Thanks so much for watching. And if you've enjoyed the content, remember to subscribe, smash that like button. We'll see you in the next one. Bye for now, guys.